Greetings, everybody. Welcome to Liberty Call. Today is Wednesday, July 5th, 2023. Hope everybody's having a good day out there and hope you had a good holiday weekend. It is a little cloudy and overcast here in Colorado. More rain's coming our way. We just can't get enough of it this year, and hope that's making all the tree huggers happy because they're always crying and whining about the drought and all the good stuff. Anyways. All right. Well, a lot of red on my screen as far as the markets. Not the greatest day, but certainly not terrible. If it's your first time watching Liberty Call, I'm glad you're here. Thank you very much. Please give me some thumbs up, like, share, subscribes, follows, all that good stuff. And let's go ahead and jump into the numbers for Wednesday. All right. Dow Jones was down 0.38%, 129 points, closed at 34,288. S&P 500 was down 0.21%, closed at 4446. NASDAQ down 0.18, closed at 13,791. The VIX was up 3.5% today. It's currently at 1418. Canada was down 0.5%. Brazil up 0.47, and Mexico up 0.19%. Over in Europe, Germany was down 0.63. The UK was down 1.03%. France was down 0.8. Netherlands down 1.13. Spain down 1.06. Italy down 0.59. Switzerland down 0.21 and Portugal down 0.16. Both Russian exchanges in the red. MOEX down 0.11, RTSI down 1.83. And the overnights in Asia, the Nikkei in Japan was down 0.25%. Australia was down 0.35%. New Zealand up 0.09. In China, the Shanghai was down 0.69%. The Shenzhen component down 0.91. China A50 down 1.08. DJ Shanghai down 0.66. Hang Seng down 1.57, and the Taiwan weighted down 0.49% for the day. All right. So, like I said, not the greatest day, but certainly not the worst. And, really it just feels like, we're just waiting for, something bad to happen to cause the markets to collapse. Is it going to be recession? Is it going to be some sort of dollar crisis, a debt crisis? I mean, who knows? I mean, it's kind of up in the air, but, just my personal feeling, I think there's some bad news on the horizon. I just don't know what it is yet. All right, well, let's go ahead and jump into the market recap. Wall Street keeps modest losses after Fed minutes. On Wednesday, the Wall Street main indexes experienced slight declines following lackluster economic data from the U.S. and China. The release of minutes from the Federal Reserve's latest meeting also had an impact on stock performance. The minutes revealed that the Fed agreed to keep interest rates unchanged at its June meeting, opting to wait and assess whether further rate hikes would be necessary. Investors largely anticipated a rate increase at the Fed's next meeting later in the month, and stocks maintained modest declines after the minutes were released. In terms of economic data, new orders for U.S.-made goods in May increased less than expected, raising concerns about a potential economic slowdown. Additionally, a private sector survey indicated that China services activity expanded at its slowest pace in 5 months in June. The market is awaiting more economic data, including the monthly U.S. jobs report, which could provide insight into the Fed's rate trajectory. If there continues to be a cooling of inflation, it may impact the likelihood of further rate hikes. Chip stocks faced losses after China announced it would control exports of certain metals used in the semiconductor industry. This move comes amid increasing tensions between Beijing and Washington regarding access to high-tech microchips. Shares of Meta Platforms, the parent company of Facebook, rose ahead of the expected launch of its Twitter rival app, Threads. Mega-cap stocks like Meta have been driving gains in major equity indexes this year, including the NASDAQ Composite, which experienced its largest first half increase in nearly 40 years. Looking ahead, some analysts suggest that there could be a convergence in stock performance, with larger stocks potentially pulling back while average stocks catch up. Market participants will be closely monitoring future data releases to regain a clearer understanding of the economic landscape and its potential impact on the markets. All right, so people weren't real happy about the Fed minutes. Let's dive a little deeper into that. Almost all Fed members see future rate hikes amid unacceptably high inflation. The Federal Reserve's minutes from its June meeting showed that almost all, and that's in quotes, policymakers supported the resumption of rate hikes following a pause. Concerns about the strength of the labor market and persistently high inflation were cited as the primary reasons for the need for further tightening. The minutes revealed that participants in the meeting judged additional increases in target federal funds rate to be appropriate in their economic projections for 23. Fed Chair Jerome Powell had also reinforced expectations for rate hikes, indicating that monetary policy was not restrictive enough. While the Fed emphasized the importance of allowing previous tightening measures to filter through the economy, some members expressed the possibility that the effects of the past policy tightening had already been realized, signaling the need for further rate hikes. At the meeting, the Fed upgraded its rate hike forecast, projecting a terminal rate of 5.6% by mid-23, suggesting 2 more hikes ahead. Inflation expectations were also revised upward, with core personal consumption expenditures price index forecasted to be 3.9% in 23. The minutes revealed that the pace of inflation was still considered unacceptably high, and that's also in quotes, with annualized inflation running at 4.6%. The slowing of goods inflation was slower than anticipated, adding to concerns. Market participants appeared to be anticipating more rate hikes, with the majority of traders expecting the central bank to resume hiking rates at the July meeting. The United States 2-year yield, which is sensitive to Fed policy changes, has also reflected expectations for tighter monetary policy. Economic data, including the monthly jobs report and consumer inflation report, will be closely watched ahead of the Fed's July meeting. The tight labor market remains a concern for the Fed and it has the potential to push wages higher and keep services inflation elevated. Mixed signals in the labor market have been observed, but analysts expect solid payroll data to be reported. Jefferies, for example, anticipates another solid increase in line with recent trends. So the Fed, or the people at the Fed, seem to think that this rate hiking cycle is nowhere near a close, at least at this point. So we'll see what they say at the meeting in a couple of weeks. That's on the 25th and 6th. So about 3 weeks from today, I guess. All right. Last up, some not so good news. This comes from Zero Hedge. It's titled Bankruptcy Filings Show Credit Slipping Despite What Spreads Say. This was written by Simon White of Bloomberg Macro. See what he has to say. All right. Recent data on bankruptcy filings suggests a concerning trend of increasing bankruptcies, loan charge-off rates, and delinquencies. This contradicts the current state of credit spreads, which have remained stable throughout the year. A chart comparing bankruptcy filings and credit spreads reveals that despite credit spreads remaining idle, bankruptcy filings have risen significantly. Historical data shows that previous surges in bankruptcy filings were preceded by wider credit spreads. While some readers have questioned whether credit spreads are a more accurate reflection of market conditions, it appears that the rise in bankruptcy filings might be a more reliable indicator. The weekly data on bankruptcy filings sourced from Bloomberg leads the official quarterly and lagging Chapter 11 data. Additionally, bankruptcies tend to lag behind the business cycle, typically peaking at the end of a recession. However, the extraordinary measures taken to limit bankruptcies during the pandemic in 2020 resulted in a less pronounced peak compared to the 2008 recession. Furthermore, bankruptcy filings also serve as a leading indicator for bank loan charge-off rates and loan delinquencies. The increase in bankruptcy filings suggests that the peak of charge-off rates is accelerating, and delinquencies are likely to follow suit. Despite the concerning signs, credit spreads have shown little reaction thus far, possibly due to the suppression of equity volatility. However, any disruptions in the equity market could prompt a rapid repricing of spreads to align with the deteriorating credit landscape. Overall, the data indicates a worsening credit environment, with bankruptcy filings and related indicators pointing to two potential challenges ahead. The discrepancy between rising bankruptcies and stable credit spreads suggests that credit markets may not be accurately reflecting the underlying credit conditions today. All right. So, in my previous life, I was a credit and collections agent and basically hunted down people who didn't want to be found to get back the money they borrowed from my employer at the time. And it was, anytime delinquencies went up, it typically was a sign that the economy was slowing down and starting to falter. So we shall see if the trend or if that trend continues and gives us a sign that, bad things are on the horizon. I know I've been saying that for a while now, but, unfortunately, just more and more data comes in to reinforce the fact that we probably got, some worse stuff ahead of us before we get to the good stuff, unfortunately. All right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope you have a wonderful evening, and I'll talk to you next time. Adios.